Hey traders, Tunapan here, founder of Master the Markets, Illustrates Conference and the Traders Open Day. So today's topic is all about 3 trading stats that you must have. So you do remember that I did talk about the 3-step trading methodology sometimes, over in talks and conferences and seminars. And one of the components of that, of the 3-step trading methodology, is the optimization component. Now the optimization component is where you're really looking at your stats to see how you can actually optimize your strategy or review your stats, what's going wrong, what's going well, what can be done to be improved. And in that stats review, there's a few stats that you definitely must be looking at, okay? And that's what I want to be talking about today. Now the first one that we are looking at, it starts with R, okay? And probably you guys would have guessed it by now. It's called reliability, okay? Reliability. Okay, reliability. Now, what do we actually mean by reliability? It's very simple. Basically, all we're asking about here is percentage of winners to losers, okay, is what we are looking at basically. Right, so we are really looking at how many trades actually won as opposed to losing. So for example, sometimes you can have systems where there's a 40% reliability, 40% winners, 60% losers, or you can also have systems where there's 70% winners and 30% losers as well, okay? You can have either one of them. Usually when you are swing traders, when you're really looking for a low frequency, high profitability kind of strategies, the reliability usually reduces because each trade actually is looking at giving you a more higher profit. I'm going to explain that as we come along into the second point. So the first test you need to look at is your reliability of your strategy. The second one, because not only is it important to know how many times you're winning, because that's not really the whole picture. The second one is where we need to know, where it puts all into perspective, is basically your average winner to loser, okay? Average win to loss ratio, okay? Is what we call average win to loss ratio. So what do we mean by that? Basically, it's very similar to your reward to risk ratio, okay? But one critical thing traders I must mention is that most usually, some traders usually say is that, they have to take like a 3-to-1 reward to risk ratio trade or a 2-to-1 reward to risk ratio trade. That is all expected reward to risk ratio. You need to see how well is your strategy performing actually, okay? That's the most important point. And what we are then looking at over here is then we are looking at, in those lines, we're looking at the average winner, the actual winners, how much did they make to the average loss that they made as well. So even though you may have a 40% reliability system where it's only winning 40% of the time, but if your average win, actual win is what I'm talking about, traders, is, and let's say is about 200 pounds to an average loss of about 50, or about, let's say, about 80 pounds. So we got something of about 2.2 is to 1, okay, is what we are really having over here. Let me just see. So yeah, I think it's about 80, so 2.5 if I'm not wrong, isn't it? Yes. I think 2.2 is the one. I mean, I'm not really getting that absolutely right. But in any case, so this is what I'm looking to tell you over here, is that we're looking at average win to average loss. And that's what you need to calculate actually in your stats of how much is it winning on average, your winners to your average loss. The final thing, the final stats that you need to know is your expectancy, okay? Is your expectancy. Now, in terms of expectancy, what you're really looking at over here is basically your net profit. And not only just net profit, we're looking at the average net profit over here, okay? Average net profit. Average net profit over your average loss gives you your expectancy. Now, what does this figure actually tell you? So, for example, you had something like 0.5, okay, from that calculation. What that is telling you is that how much each of your trades is making. For example, if you had 0.5, all it's saying is that through the expectancy formula, it's a normalization factor over here. What it's telling you is that each trade is making you, let's say, 0.5% profit. Okay. Now, traders, Just a very quick tip for you, something for you all to think about. If you want to increase that number, very simply, you need to reduce the loss point, loss factor. This is why every single trade that you take, the most important thing I always keep stressing to people is your risk, risk, risk. Keep managing, keep focusing on the risk, okay? Because the upside will always look after itself. And when you do that, when your average loss is really minimal, that expectancy number really starts shooting up, all right? So these are the three things you can definitely look at into improving and optimizing your systems to see how well your strategy is doing. So one is reliability. Second is your average win to average loss ratio, which is actually an actual profit to win, your reward to risk ratio. And then thirdly then is your expectancy, okay, average net profit over your average loss. So definitely do go and look at this stats, go and read up on it, or even give us some questions, post your comments and questions if you've got any challenges in knowing how to come up with these figures. We in fact have got trade log journals and all that measures this with all the formulas in it anyway. That's in our Traders Essential Kit as well. So I believe that's been really useful for you all to analyze your stats, analyze your strategy performance so that you know how and where you're going wrong and how to optimize your strategy so as to push that equity curve into positive territory. Traders, this is the end of this video. Till the next time, stay disciplined, follow your trading plan, and keep trading like a master.